Picture a fortress. But we're not talking about a fortress made of stone or steel. We're talking about one built entirely out of pure, cold mathematics. It was designed to be absolutely bulletproof against the chaotic, unpredictable swings of human emotion. For decades, Bridgewater Associates built exactly this. They created the world's most profitable hedge fund, a literal titan of industry that generated billions by treating the global economy like a predictable symphony of data. It was supposed to be flawless. But what happens when the ultimate money machine is suddenly blinded by a shock it was literally never programmed to see? Welcome to this explainer. Today, we are unraveling the gripping story of an unprecedented mathematical breakdown. Think about this for a second, because it's a genuine mystery. How does a $160 billion financial fortress actually fall? I mean, this was an engine that had been stress-tested against the Great Depression, it survived the dot-com bubble, yet in just a few terrifying weeks, this absolutely unstoppable force hit a brick wall, and it left the smartest minds in global finance completely stunned. To solve the mystery of how the math finally broke, we first have to understand the sheer, untouchable perfection of the machine itself. Because, to really appreciate the fall, you have to witness the rise. Starting out in a tiny two-bedroom apartment back in 1975, Ray Dalio and his team at Bridgewater completely re-engineered institutional investing from the ground up. They launched the famous Pure Alpha strategy in '91 and the all-weather strategy in '96. But their absolute crowning moment, that was 2008. While the entire global financial system was literally burning to the ground, Bridgewater calmly posted a 9.5% gain. They easily beat the greatest market crash of our generation. To everyone watching, they seemed totally, completely invincible.
Okay, let's dive into this. The real secret to their invincibility was a brilliant, frankly revolutionary piece of financial engineering, strictly separating what's called alpha and beta. Before 1990, investors just mashed these together, completely fueled by human bias and gut feelings. Dalio changed all that. He defined beta as standard market risk, basically just riding the wave of the economy. But alpha, that's the holy grail. We're talking highly calibrated investments generating massive returns entirely independent of the market. By splitting these up, they shifted investing from an emotional art form into a cold, hard, exact science.
And this brilliantly illustrates the core logic of that science. They called it the macro environment matrix, or just the four-box framework. And honestly, it's beautifully simple. Bridgewater categorized literally every economic state using just two levers. Is growth rising or falling? And is inflation rising or falling? By knowing exactly which assets thrive in each specific box, like stocks, during rising growth, they could systematically allocate their money. No matter what crazy curveball the world threw at them, if they knew which box they were in, they were perfectly prepared.
Using that framework, they built the legendary Pure Alpha machine. Now, don't picture a room full of sweaty traders yelling at screens. This was a highly complex algorithmic system quietly trading across 80 global markets all at the same time. They held dozens of positions, rigorously balancing their risk across completely uncorrelated assets. They stripped away every ounce of human bias. They literally didn't care if the overall market was crashing or booming. They only took on risk where their rigid models calculated a strict mathematical edge. In theory, there was no way they could lose.
Look at that long-term, steady, upward curve stretching out towards 2019. That right there is the absolute magic of their risk parity strategy. You see, traditional diversification, like a standard 60% stocks, 40% bond split, actually leaves you heavily exposed to those riskier equities. Bridgewater fixed this by using leverage. They borrowed money to increase the risk and the return of safer bonds, matching them up with the risk profile of stocks. When you perfectly balance actual risk instead of just balancing dollars, you get this beautiful picture of continuous, uninterrupted wealth compounding.
But as it turns out, perfection is a heavy crown to wear. In 2019, a tiny, almost imperceptible crack appeared in the armor. The S&P 500 went on a massive 29% tear, but Bridgewater's Pure Alpha fund, it essentially flatlined. It was their very first flat year since 2000. Behind closed doors, these historically flawless, back-tested models were slightly misfiring. They were struggling to capture a soaring market that seemed to totally defy gravity. It was a subtle whisper that the machine was starting to lose its absolute grip, right before true disasters struck.
Then came the spring of 2020, the invisible shock. COVID-19 swept across the globe, and by mid-March, the perfect money machine broke. The flagship Pure Alpha 2 fund plummeted 13%. The supposedly bulletproof all-weather portfolio dropped 14%. By the time the year ended, Bridgewater had posted an eye-watering $12.1 billion loss. The entire financial world watched in absolute shock. All those cutting-edge algorithms and decades of historical data, they couldn't stop the bleeding.
So the crucial point is, when the math finally broke, Ray Dalio, the man who spent his entire life trying to remove human emotion from the investment game, made a startlingly human admission. He said, "We did not know how to navigate the virus. In retrospect, we should have cut all risk." Think about that. The algorithms were frozen because there was literally no historical precedent for a sudden global economic shutdown. The system simply couldn't find its edge. So the smartest machine in the world essentially just sat on its hands while the markets collapsed around it.
And this brings us to the ultimate financial thriller mystery of 2020. How does a massive $160 billion engine, an engine built specifically to balance risk, end up crashing alongside everything else? I mean, the whole point was to survive a stock market tank because other safe assets would rise, right? So why did diversification fail when it was needed the most? The answer to that lies deep down in the interconnected plumbing of global finance.
Let's walk through the rapid chain reaction that shattered their models. First, the pandemic introduced totally unquantifiable uncertainty. You can't model what you've never seen. That caused an unprecedented spike in market volatility. In response, massive banks panicked and started hoarding cash, withdrawing liquidity to protect themselves. Suddenly, assets that normally act completely independent of each other became highly correlated. Everything was moving together, downward. Finally, the algorithms, detecting this massive risk, automatically triggered a mechanical death spiral, forcing immediate sell-offs just to meet margin calls.
Now, what's really interesting about this is the stark contrast between academic theory and the brutal reality of a black swan event. In a normal market, assets zig and zag. If stocks take a hit, investors usually run to safe havens like government bonds. But in the sheer, unadulterated panic of March 2020, liquidity completely vanished. Cash was literally the only thing people wanted. Because of that, stocks, bonds, and even gold all plummeted in total lockstep. The very diversification that was meant to protect Bridgewater actually amplified the panic, as their models searched for a safe haven and found absolutely nothing.
Take a look at this heavy reliance on debt and bonds, making up nearly 55% of the portfolio. Remember earlier how we talked about risk parity, using leverage to make safe bonds just as risky and rewarding as stocks? Well, suddenly, that leverage became a fatal flaw. During the total frenzy of forced liquidation, those leveraged bond positions were incredibly vulnerable. The borrowed money they used to buy them magnified their losses exponentially. The exact mathematical mechanism built to equalize risk ended up creating a massive, crippling vulnerability instead.
Okay, so the dust settles, and that $12.1 billion loss, it was a brutal wake-up call for the firm. They quickly realized the world had fundamentally changed. The long, comfortable era of constantly falling interest rates and seamless globalization was definitively over. It was being replaced by unpredictable supply chain shocks and rampant inflation. This whole new paradigm required a completely new machine, sparking an unprecedented overhaul of Bridgewater's macroeconomic views and, incredibly, its storied leadership.
And let me tell you, this overhaul was absolutely ruthless. Ray Dalio officially stepped back, eventually handing the reins to a new generation, with Nir Bardia taking over as lone CEO. But the most shocking move wasn't personnel. It was philosophical. Bridgewater actively restricted new capital and actually returned money to their clients. In a world where hedge funds survive purely on the fees tied to massive assets, intentionally shrinking your footprint is basically unheard of. But the new leadership knew that surviving this volatile new era meant prioritizing nimble, adaptive performance over just maximizing fee revenue.
Let's move forward and see how this builds, because this radical reboot, it totally worked. It led to an absolutely staggering comeback. Recognizing that the days of easy money were over, Bridgewater positioned themselves aggressively. After a solid gain in 2021, their pure alpha funds skyrocketed during the absolutely brutal 2022 bear market, posting a breathtaking 32% gain in the first half of the year. How did they do it? By trusting the new models. They aggressively shorted interest rates in the US and Europe and pivoted heavily into commodities to ride the global inflationary demand shock.
But you know what? The evolution didn't stop there. Realizing that even their updated traditional algorithms weren't going to be enough for the future, Bridgewater launched a massive new $2 billion fund in mid-2024. And this wasn't just another macro fund. It was driven entirely by machine learning and artificial intelligence. They integrated cutting-edge large language models from OpenAI, Anthropic, and Perplexity directly into their core decision-making. The firm famous for strict, unbending static rules was handing the keys over to dynamic, self-learning AI capable of synthesizing global data at a scale humans can't even comprehend.
So what can we actually take away from this entire financial saga? First, systematization absolutely requires humility. You have to define your constraints before disaster strikes, because sizing matters way more than directional accuracy. Second, regime recognition is everything. Knowing when the world shifts from deflation to inflation is where the true money is made. And finally, static rules will eventually fail. Markets are living, breathing ecosystems. A perfect strategy that works brilliantly for a decade can become obsolete overnight if it doesn't adapt to structural shifts.
Bridgewater's wild journey, from a supposedly flawless algorithm to a devastating historic crash, and finally an AI-driven rebirth, proves that you can bounce back if you're willing to completely rebuild your worldview. But it leaves us with a lingering, slightly unsettling question. As artificial intelligence increasingly takes the reins of global markets, processing billions of data points a second, can any machine, no matter how smart, truly prepare for the next invisible unknown? I guess we'll just have to wait and see. Thank you for joining me on this explainer. Keep questioning the data, and we'll see you next time.